thank you for coming. My name is Damian Russell. We're going to actually start. I've got about maybe 20 minutes for you, and then our featured speaker, Lamarr Baxter, is going to get up here and give you some valuable information about retirement, investing, home mortgage, mortgage qualification, and so on. So very valuable information today, and I hope that you'll get value out of it. And if you have any questions, we'll leave contact information and everything following and on the bottom of the screen for you as we're going. So let's get started. As I said, my name is Damian Russell. I am the author of Financial Literacy and Ownership, What They Don't Want Us to Know. The session is geared for our Black and brown communities and minority communities as a wake-up call. I wrote this book a few years ago, and I did so for the reason that, I was bothered. I was upset, bothered internally, call it what you will. What was bothering me was the fact that we had this huge problem, this huge issue, as I perceived it, among minority communities, and no one noticed, or no one seemed to even realize that it was a problem, or that there was an issue. And we're watching protests about, Black Lives Matter, and I won't name them all, but similar issues like that. And my concern was that, yes, absolutely, those are valid issues. However, they are not the issue. The issue is this: financial literacy and ownership. And you'll see as we talk about wealth disparity in America, the difference, the wealth gap between minority communities and non-minority communities, that wealth gap. If you read this book, you'll understand that that wealth gap is caused primarily because of our lack of financial literacy and ownership in America. So, statement's pretty simple. What will you do? And the book, as I wrote it, is actually a call to action. This is the most pressing issue facing Black and brown communities today, primarily because in these communities, most people in these communities don't even understand the gravity of it or that the problem even exists. So what I would say is that you've heard the saying, I hope, that the greatest trick the devil ever pulled was convincing people he did not exist. That leads to the proliferation of evil, the proliferation of all things bad. Well, this I see in a similar vein. The greatest trick that's been pulled on us as minorities in America is to convince us that this is not an issue, this is not a problem. Financial literacy, not an issue, nothing you need to worry about, nothing you need to try to acquire, not a skill set or a mindset that you need to achieve, and that ownership, not so significant. You go ahead and rent. Go ahead and finance your cars, rent your homes, rent your offices, or if you have businesses that you own. Otherwise, go ahead and punch the time clock. Ownership, don't worry about that. We got that over here. That's why I named the book Financial Literacy and Ownership: What They Don't Want Us to Know. It's not this conspiracy against minorities. It's just that they kind of prefer, right now we don't know, we're not in the know, and they kind of prefer to keep it that way. If we could just keep on subsisting outside of the know. And hopefully the book, some people thought that I was going to go deeply into finance, financial literacy, investment strategies, investment calculations and computations. I did not. It is not a math book. It's an easy read. The purpose of the book was to bring awareness, simply bring awareness to this issue, which I feel has gone largely undiscovered or unrevealed. I talked to people in preparing to write this book, and they're like, "What? That's an issue? Why don't you write about Black Lives Matter and Black lives being snubbed out by white police officers?" And I had to think, like I said, that is a valid issue, but that is not the issue. First of all, there are far more blacks killing blacks than there are white police officers killing blacks. Far more. Every minute of every day, every hour of every day, in every city in America, this is happening. Where's the protest in that? I don't see the whole movement, the protest in those instances. I wish I did. But the reality is, I call to all of you to understand that this is the real issue. While all that is going on, I won't call it a distraction because I don't want to belittle it, but while all that is going on, this has been persisting since Jim Crow. This has been persisting from the dawn of our time here in civilized America. The ability to keep us unaware, uninformed, and just plodding along. In the book, I kind of likened it a couple of times in a couple of passages in the book, I likened it to The Matrix. If you can already recall the movie The Matrix. The reason I made the comparison to The Matrix was because we are in minority communities, we're just kind of subsisting like in The Matrix. You recall the people were batteries, basically, to power the machines, but they didn't know that. They thought they were going about their everyday lives. They were kept out of the know. That was the thing with the two pills. Pick one. Do you want to know or do you not want to know? The red and blue pills, if you can remember that from the movie. And I'm stretching my memory because it's been several years since I've seen it. But I made those comparisons in the book for that reason. We are just subsisting outside of the know. We have no concept or clue what we're missing, what we're not involved in. The chess match that's being played all around us, we think, even those who are aware slightly think that, oh, that doesn't have anything to do with me, I'm not in the game. You are in the game, you're just a pawn in the game. What I hope to do in the book is bring, as I said, and heighten that awareness, get you in the know so that you can start participating in your own game. Get out of the role of being the pawn. You're still being moved about the board for someone else's gain. I'm suggesting that as minorities in America, we too can be chess masters. We can too step back and play the game and move the pieces about the board for our gain. The amount of buying power and wealth that we have as a community is indisputable. The issue is, are we aware of it? Are we aware of the ability or the means to use that as leverage to gain clout, power, an achievement or accomplishment, or even just benchmark milestones in America? All other communities are. Even immigrant communities come here and they understand this from day one. They understand it because they, and I'm talking children, they see it from a young age. They see their parents and other people in their communities, their doctors, their lawyers, they own the hardware store, they own this business, they own that business. It's within the community. Think Little Russia or these little communities, Chinatown, where the money's kept within the community because people are serviced and they're able to get services and products and goods within their own community. So they earn $1, maybe outside the community, maybe they have a job outside the community. Those dollars come back into the community. They're spent within the community. The average dollar in a Russian community circulates, I think it was 4.7 times, or I'm sorry, 7.4 times. In the Jewish community, for example, average dollar circulates 13.2 times before it leaves the Jewish community. Black, brown, minority communities, less than 1. The average dollar earned outside of the community, because you go to your job and you come back into the community, but there are no black services, goods, or products, and if there are black business owners, we're not patronizing them. So those dollars will go to Walmart and spend that dollar. We'll go here and spend that damn dollar, but we won't spend it in our own community. So statistically, I'm telling you that less than 1 time a dollar circulates in black and brown communities. We're so damn eager to earn our buck, cash our check on payday, and hit the streets outside of the community that we are not spending money in our own communities. We're not empowering, enriching ourselves. We're not gaining any wealth as a community. We're just plodding along, and we've got plenty of money. Black folks work, brown folks work, we have jobs, we have income, we own businesses, but what do we do with the money is the question, compared to what other communities do with their money and with their hard-earned dollars. We're lacking, folks. We're missing the point. And that's what I hope to address in the book as well. And I think I did so fairly well. I just need people to read it to get the message. Take the message to heart. It's real. And this is not an adult message. It's not a child message. This is a message for all of us. The reality is we can't begin to, as I address with some of the other immigrant communities, they covet what they see. They grow up learning that they can grow up and be business owners. They can own the business down the street, the store around the corner, the gas station, on the block. They can own all this stuff. They grow up learning that, seeing that, not being told. They see it. It's real. Their neighbor owns the gas station. And he looks like them, sounds like them, speaks with an accent like them, has the same coloration as them, has the same origin as them, and comes from the same place as them. That's what they learn. We're not learning that. Our children are not learning that. They grow up in communities where everybody rents everything. There's no discussion really of ownership because there's no understanding at the adult level of the power of ownership. We cannot covet what we don't see, what we don't know. How do you expect a kid to covet or desire or want something or want to achieve something that they don't know, one, either exists, they don't understand the value of it, so they don't appreciate it. It's not something they wish to achieve. They see rap videos, they see ignorant television shows and these fake-ass reality shows, and that's what we covet. That's what we want to be. We want to be the rapper. We want to be the ball player. We want to be the entertainer. Do we want to be the CEO? No, I'm telling you, there are plenty of black CEOs of Fortune 500, 100, and 1,000 companies that you would just be blown away, mind blown, to understand that there are black people and minorities at the helm of these large corporations. But they are. You don't hear of them. You don't see of them. And that's unfortunate because it is that reason that our children don't desire that. They don't covet that. They don't believe that they can achieve that because they don't see it. They have no example. They have no role model, no mentor that believes that they can be the CEO of American Express, that they can be the CEO of McDonald's. Say what you want about the menu, there's a black person at the helm of McDonald's. Did anyone know that? Why would you? But I bet you can tell me when Jay-Z's next release is coming out. And I admire him because he's a wealthy man and he's a smart man. But the reality is, we need to see blacks in accomplishment outside of that arena, outside of that box. If we can, then our children will begin to covet these things and believe that they can achieve. And belief is powerful. Belief is more powerful than anything you can possibly hope to foster in a youth. But it starts at home. The parents have to believe that their children can achieve these things. Their parents have to show their children that, yes, they can achieve these things in America. And without that example, mentorship, our children will never wish to achieve or believe these things are possible. So with that, I'm going to start to conclude. I'm really interested in getting our next speaker, Lamarr Baxter, up here. Lamarr is going to go into a little bit more depth on that computation, calculation, investment strategies, retirement scenarios and schemes and schematics that would benefit you, and begin to kind of foster that mind shift, that paradigm shift in mindset or thinking that we need as a community to understand that there are financial angles and strategies out there that are available to us that don't require great wealth to begin, but can achieve and gain and garner great wealth in the end. Lamarr Baxter is a financial expert. He's a retirement expert. He's an actual active practicing mortgage originator and specializes in self-directed IRAs, 401ks. I'll let him get into that a little bit more, but I just want you to understand the value that this gentleman can bring to you if you just hear his message. And that's where we're at. I want to thank you all for watching today. Again, the book is Financial Literacy and Ownership, What They Don't Want Us to Know. I have been Damian Russell. I'm the author, also an owner of a real estate company with my wife. We own Berkshire Hathaway HomeServices Elite, the Russell Realty team in Sacramento. So I come from a real estate background. Lamarr comes from a finance background. I could have gone into some of that today. I really want to focus on the message for the book. And again, I ask you, what will you do? You is emphasized there because that is the question. What will you do? You have much that you can do, in beginning with educating your children, educating yourself. Grab a book, check it out, read it, educate yourself, begin to have that shift in mindset. And yes, one person can make a difference. Thank you.
I'd like to thank everyone for coming in today. Great presentation by Damian Russell. Once again, what he covered in his book and in terms of what he's actually covered in his book and what he covered in his presentation today is really important, and actually information that unfortunately should have been taught in high school, should have been a requirement to graduate from high school, and have an idea that that's probably designed that way to kind of keep a person ignorant meaning not knowing, puts them at the mercy of the financial institution in terms of banks while they're being charged predatory interest rates, so on and so forth. Think of a situation to where the masses of the U.S. population had adequate financial literacy to where they wouldn't be paying a lot of these predatory interest rates because they would have decent FICO scores and have their finances in order. And like I say, it's all as a result of because a lot of times this information we don't know. And we're trying to do our part in terms of making sure we kind of change that mindset and also that practice, and kind of hopefully encouraging parents, as I've done with my children as well as I'm doing with my grandchildren, emphasizing the importance of financial literacy, because at the end of the day, it's your money, and once you sign on a dotted line, it's basically you agreed to those terms, regardless of whether you knew what that you actually signed or not. So what I'm going to be covering today is kind of entitled Wealth, Legacy and Real Estate. I'm going to be focusing on real estate. We kind of look back in history. If you look back from time of slavery up to the present, the key emphasis is always placed on owning land. I was discussing with Damien and a few other people as a result of financial literacy in the Black community. And if you look at the documentary on Black Wall Street, this basically gives you an example. And there's another city in Florida back in the day called Rosewood. It basically showed African Americans actually purchasing land and building communities. And once again, when you're actually building communities, it starts with acquiring land. And if you acquire land and you hold it over time, you'd be surprised what type of return on investment. Owning and acquiring land basically puts you in the driver's seat. It puts you in a position to where you own the property. You can do what you want with that property, whether it build residences, build businesses, you name it. And once you have control of that land to build those residences, those businesses, that pretty much takes care of one of our root problems as it relates to people of color and African Americans, which is unemployment. If we can basically be self-sustaining in those areas, we can basically correct those two problems that face our community. So I'm going to be talking about, just kind of give you an overview. I'm going to be talking about, like I said, creating the legacy through acquiring real estate. We'll be touching on the credit requirements. And in this case, what I'm going to be covering today when it comes to credit requirements is more or less for those who should be going out there, who have the means. And a lot of times when I say have the means to go out there and acquire property, it's not what most people think in terms of credit and as well as reserves and assets. A lot of assets are basically right at your fingertips. You just have to know where to go to find it. I'm going to be talking about retirement funds as a source of capital to be able to go out and leverage against real estate, and being able to partner retirement funds with private capital. Most people believe that it's impossible to obtain financing to invest in real estate, whether it be owner-occupied or for investment. They say you have to have perfect credit. Past foreclosures and past credit history is a problem. It's usually a disqualifier to what most people think. You have to put down more than 50% in order to invest, especially in investment real estate. That's not true. They may have been true in the past, but as of recently, because there's masses of institutional lenders as well as private lenders out there with capital to invest, that's not the case anymore. You must have liquid reserves. That's not the case. Most lenders, when it comes to investment properties, unlike residential properties that you're going to live in, they place most of their qualification as well as their requirements for the loan on the property. So what you can actually do is acquire a piece of property, basically based on the projection of accrual of equity over time is how they will basically determine what the terms will be for that loan. A lot of people think you have to have liquid reserves. You must have experience in real estate investing. Although it's not required, it's helpful, especially if you're dealing with a private money lender and even some institutional lenders who what they don't want to do is loan money to you and you go out there and mess up the deal and lose money. So it's always a good idea to have experience. And if you don't have the experience, there's plenty of people out in the real estate investment community that does have the experience and even sometimes the capital that you can partner with. Because over my years operating with the investors, I've actually helped investors, especially new investors, partner them up with investors who has the capital and maybe want to supplement a retirement income or whatever the case may be. But the objective is to make money. But if you have knowledge and you can go out there and put that knowledge to work, there's capital out there. I mean, because a lot of investors are much rather invest in real estate, something that's secure, that's tangible, that's usually going to appreciate over time, unlike maybe a stock or a bond that can basically, you can lose that money overnight. And once again, once you start to educate the investors and even some of your potential investors who's going to invest in your projects, the difference between investing in some of your traditional investments, which most are not secure, versus investing both short-term and long-term into a real estate project, you'd be surprised that how fast and how prompt they'll move in your direction. And what's nice about that is once you get them on board, that's one of many sources to follow when it comes to capital that you'll need to acquire capital to purchase real estate as it relates to investment property. So one of the other myths is that you have to be a certain age. So these are the requirements here in terms of what's required to apply for, whether it be a residential loan to live in, a property to live in, or to basically qualify for a loan as it relates to investments. Institutional lenders will loan up to usually up to 60, 65%, and 70% on some projects, but you only have to have 620 FICO score. And once again, as a minimum, most people say, well, wow, require more than that to basically get into a residential property. But there's other variables that the underwriter will take into account when it comes to approving that loan. Stated income loans, that was something that was used in the past that contributed to the market crash when it came to owner-occupied properties. Stated income loans was something that was used and it really served its purpose prior to, say, 2001, 2002, when there was the only time you would be able to use a stated loan, income loan is if you were self-employed or if you were in a position to where you had variable income, such as sales. So that's coming back, but the loan to value is usually about 75% because there are a significant amount of people, whether they're trying to invest, but especially if they're trying to buy owner-occupied property, they need to state their income. And in most cases, because tax returns, they change the rules in terms of qualifying with tax returns. No longer are they able to qualify on their gross income, they have to qualify on their net income. A lot of times they don't qualify based on sometimes having a loss for that particular year or relatively no income for that year. So this is where the stated income loan comes back. But for the investor, it's great because it can go up to 70% loan to value. What's nice also, you can get real creative. If you don't have an investor have the capital for, say, for example, the 30% down, and if you can work something out with the existing seller to have them carry back a note for the other 30%, it benefits you as the investor or the buyer of the property, but also benefits the investor or the seller of the property because there's tax benefits. That's less money they have to pay on capital gains if they carry back that second, opposed to taking that lump sum. So there's a lot of different ways you get creative with that. The other option is to partner with a self-directed IRA. So we'll talk more about what a self-directed IRA is, but this basically is a vehicle where you actually use or leveraging retirement funds to partner with private capital or other capital, or just purchase real estate outright. Non-recourse loans are also available for your self-directed loans, self-directed IRA funds. So basically, if you have a situation where you only have, say, $100,000 in your retirement account, and if that $100,000 accounts for the 30 or 35% down that's required by the lender, I have access to non-recourse lenders that will basically give you that 60 or 65% LTV loan. So once again, there's not many excuses for many as to why they can't get into real estate. It's just actually knowing what to do, what programs are available, and actually taking action and moving forward. Many non-institutional lenders base qualification on the property. So as I mentioned earlier, with the residential loan or property that you're going to live in, they place emphasis on the property, but a huge emphasis on you as the borrower, your income, your assets. But when it comes to investment properties, it's a different arena because once again, there's two revenue generators for that property: the monthly income if it's long-term and the appreciation of equity. So that's the reason why they will gamble and put more emphasis on the property in terms of the compensating factor to make a loan decision as far as approval, unlike a residential property. Because if you lose your job with a residential property, they're basing your ability to pay on your income. You lose that income, you basically 6 months or however long it takes you to get a job, you don't have the reserves, put the lender at risk. Investment property, in most cases, just get another tenant in there. I mean, worst case scenario, maybe 30, 45 days that you're out, but in most cases, part of the qualification process that you have reserves. So usually you have 3 to 6 months reserves, meaning 3 to 6 months of payments in your bank. That's part of the requirements they're going to have. So that gives them the insurance that in the event that you have a vacancy factor, meaning going from one tenant to another, that you're going to still be able to pay that mortgage. So what is a self-directed IRA or retirement plan? So self-directed retirement plan basically is like any other retirement plan that you may have, but the plan agreement is unique because unlike maybe a plan with Charles Schwab, Franklin Templeton, or any other plan administrator for retirement funds, their plan agreement allows you to invest in alternative assets. Alternative assets meaning real estate and any other type of business or anything of that nature. So usually one of the questions that come up, what can't you invest in? And that's a very short list. It's usually antiques, collectibles, or anything that you would basically take personal possession of. You can't take personal possession even of real estate because what's going to happen is when the self-directed IRA acquires the property, it won't be you. And that's one of the reasons why you're able to use this investment vehicle to purchase real estate is because you personally don't own the property. The retirement plan actually owns the property. So if you go to county records and pull up who's the vested owner on that property, there's a legal vesting that basically shows the name of the retirement plan for the benefit of you, which is your name, as the vested owner of the property. So that's the reason why most people say, well, how is it you're able to pull money out of your retirement account to purchase real estate without being taxed or penalized? It's no different than moving your money from a Wells Fargo retirement plan over to Charles Schwab. As long as those funds remain under a retirement umbrella, it remains either tax-free or tax-deferred. So what's happening is, it's no different you pulling money out of your Charles Schwab account and investing in stocks. You're not taking personal possession of those funds. Those monies are going directly from your retirement plan over to a stock. In this case here, those funds coming out of retirement plan are coming directly out of your retirement plan, going over to title and escrow, who will then record a title, lien against the property for whoever the property owner would be. In this case, if there's a lien, be the non-recourse lender for a lien, but you, or should I say your retirement plan, will be the actual vested owner, legal vested owner of that property. So once again, this is a great opportunity for those who, a lot of us have retirement plans, but we've gotten comfortable in terms of, I would say, single-digit returns. Well, say, no, we get double-digit. I said, no, there was laws passed 2 years ago to where it's required. If you look at your statement, maybe unlike past prior to 2 years ago, it basically gives you a breakdown in terms of what your return is. But this breakdown now has to include what your stockbroker or your plan administrator's fee is. And a lot of times when you deduct your fee, it's a single-digit return. And sometimes it's very low. So once you start to educate your clients, your real estate professionals in the audience in terms of why, or even if you're basically an investor, you start looking, comparing apples to apples, looking at the accrual rate of equity in real estate, not to mention the monthly return as far as rents. It's a lot better investment than putting your money in the stock market. That any given day is almost pretty much like being in Vegas, you're gambling. You don't really know when the market's going to crash or the bottom's going to come out. One thing is for sure, even though the real estate market took a hit back in 2008, no house went to zero, but there's plenty of stocks that went to zero. So just kind of keep that in mind. So I'm going to talk real quickly on the different types of plans. As I mentioned, it's just like any other type of retirement plan. Right now, most people, if they have an IRA, they have either a traditional, a Roth, simple, or solo 401k. The difference between the different plans, the traditional, the Roth, is usually for individuals. The simple, and the solo 401k is for small businesses. They usually have their own retirement plans. So if you have an existing plan right now, it's easy for you to roll over that money into one of these self-directed plans and actually invest it. Once again, whether it be real estate or business, these are great investment vehicles to use that money. And basically, one of the taglines we used to use when I was specifically operating in this industry, the self-directed IRAs, you become the expert of your money. Because if you basically are a real estate investor, you pretty much are an expert of becoming an expert. And I think you would trust yourself more in terms of investing your money than maybe what you think Wall Street's going to do with your money. Most funds are rolled over from previous 401ks or any other retirement plan from your employer, such as a 401k, 403b, 457. So what happens is once you leave an employer, you have the option to leave that money, which is kind of changing now. A lot of times within a certain period of time, you have to roll it over to another employer plan wherever you're going, or roll it over to an IRA. But that's the opportune time to where if you're leaving an employer or have left an employer and that money's in an IRA, that's your source of capital. And one of the things is to understand is that even if you rolled it over to your new employer, they usually have it subdivided in terms of what money was accruing in that retirement plan before you came over to the new company versus after. So you can actually still access and roll over those funds from that previous employer, even though if you rolled it over to the plan of the new employer. So that's something a lot of people don't know, but you can do that. And it's just a matter of basically contacting the right people and using the right language. And a lot of times it's usually reflected on your statement in terms of where the source of the funds came from your current employer versus your previous employer, so you know exactly how much you have access to pull it out of a current 401k with your current employer. So you can actually transfer funds from your existing IRA, as I mentioned. So if you already have an IRA, you can transfer that over to a self-directed IRA. There's no, once again, because you're keeping everything under a retirement umbrella, there's no tax implications or penalties. So, and then as like with any retirement plan, 401k, IRA, you have the option of growing your funds in real estate, tax-free or tax-deferred, depending on what type of plan that you have. So we're going to talk real quickly about some investment capital sources. As I mentioned, there's money's on the sideline. There's private investors, a ton of retirees out there right now that didn't recover from the crash in 2008, so they're looking to supplement their income. So this is a place to go to where if you have the knowledge and the information, or at least people on your team that has the knowledge and information to go out there and acquire property, buy it, flip it, or buy it and hold it, there's a ton of money on the sideline to where you can partner with these private investors and they will give you as much cash as you need, whether it be an individual or a group of individuals. The cash is there. And what's nice is, like I said, the selling point is that, and if you structure it properly, because no one wants to be in a Bernie Madoff situation, is that you basically want to let your potential investor know, we're going to be going through a third-party escrow, licensed escrow company, so you never be giving me money directly. That money will be going directly to a third-party escrow, and once the transaction is closed, that money will be dispersed to the seller of the property. That way that person knows, and the same thing happens once the property sells. Because you guys, depending on how you structure your investment, whether it be a TIC, which means tenants in common, or a fractional interest, when that property sells, the monies will be dispersed in accordance to who receives what relative to what they contributed in the property. So there's never any argument or mix-up in terms of who's going to get what. Usually, depending on how you structure your investment group, and whether it be a TIC or whatever the case may be, it's usually going to emphasize what percentage goes to who when it comes to whether it be monthly rental or profits from the sale of a property. So you never have a problem there. Private investors, retirement funds, once again, whether it be private capital or retirement funds, they are looking to grow that money to play catch up with what they lost after the crash. Friends and relatives with private capitals. Once again, you get people, I mean, for some it may be a little tough, but when I say friends or relatives, I mean, even strangers, a great place to go, as I was talking to a colleague earlier, is to go to real estate investment clubs. I mean, some of the bigger real estate investment clubs, the credible ones there, these are serious investors and always looking for a deal or an opportunity. When I say looking for a deal or an opportunity, somewhere to place their money. When I say that, these are people who have money to invest, or even, they're even just hard money lenders. They're just looking to put that money to work 60 to 90 days. Maybe you need the money to acquire the property or to basically rehab the property. There's a ton of money for that. Institutional lenders I've mentioned, and then hard money lenders. So you have a multitude of options when it comes to getting the capital to get into this game and to start to build that wealth and that legacy. So as I mentioned earlier, partnering retirement funds and retirement funds. So as I mentioned earlier, there's a non-recourse, there's what you call non-recourse lender. So what does non-recourse lender mean? That means that in the event, and this is something that's really a requirement when it comes to partnering retirement funds with private capital or an individual, because IRS Code 4975 states that there has to be an arm's length transaction between the retirement plan and the actual account holder. So for example, if I have an IRA and I want to acquire a piece of real estate, say 60% of the funds come from the non-recourse lender, the other 40% comes from me. Normally, I'm not supposed to be able to do that, but as long as the deal is structured properly and that loan, that non-recourse loan is not basically given to me, is loaned to my self-directed IRA. So as mentioned, I can't have any self-dealing with my retirement fund. So that lender has to basically make its loan decision based on the property alone, because obviously there's no history. If you just open a self-directed IRA to base any history on that, that self-directed IRA is actually a legal entity. That's when we say a legal vesting. It's an actual legal entity. It has its own tax ID number outside of using your Social Security number. Yes, your Social Security number is tied to that retirement account, but that tax ID number, or that self-directed IRA, has its own separate tax ID number as like an LLC or corporation. So it's actually its own entity. So what happens is your plan administrator gives you documents at the end of the year, which is called a 4598, which basically states any activity relative to that retirement plan. No different than you as an individual get a W-2 or 1099. There's tax documents issued to that retirement plan that make sure that everything is separate. The good thing is that in the event, say you own a piece of property, and that IRA says they own a piece of property, even though you're partnered with it, if that IRA gets sued, you're protected. So there's a form of asset protection, because in most cases, the IRA owns the property. So it's no different if you used to basically have a piece of property and know you're going to get sued and you transfer to an LLC. How they determine how they're going to attach your assets through your Social Security number. Transfer, if the LLC has its own tax ID number, they can't acquire or actually leverage against that property. So there's some protections also using that. And once again, qualifying for a non-recourse loan, credit history is no factor. I've had clients who have just filed bankruptcy and was able to get a non-recourse loan using their self-directed IRA and partner with it, or you just use private funds outright. But in most cases, this is an excellent opportunity for those who want to get back into the real estate investment arena and just had some bad luck when it came to credit. So as I mentioned, the asset protection component is definitely there. These lenders also will lend, because it's non-recourse, to a newly formed LLC or an IRA-owned LLC. So what is an IRA-owned LLC? So say you have 5 properties, and you have all 5 properties are rental. Someone slips and falls in one of your rentals. You don't want, because remember the IRA owns all 5 of the rentals. You don't want a situation where if that IRA gets sued, that all 5 properties are attached in the lawsuit. So what some people will do is they will set up an LLC, IRA-owned LLC for each property. So each property is actually owned by an IRA-owned LLC. So if someone slips in property A, property D is not affected because it's property A is self-contained as it relates to any litigation. But once again, what's nice about that is the lenders will lend to these newly formed LLCs. And the rates right now are as low as 6% on some of these deals. I mean, it used to be you paying 6 to 8 points. Right now it's 4 to 6 points. But once again, if you're basically crunching your numbers and realizing, okay, well, even 4 to 6 points is not a lot, especially if you penciling the deal properly and say it's a buy and flip. I mean, there's a lot of meat on the bone, so to speak. I mean, this is only for the duration of the time that you have this money, which is usually up to 90 days. So to pay 4, 6 points on it, and what will happen if you're dealing with the same lender, they're going to cut your break. They're going to give you a flat point structure, maybe 3, 4 points, because you're coming back every time. So that's why it's important to develop that relationship with either the lender, institutional lender, or even a hard money lender, because they make money on transactions. So they want to make you a repeat client. So definitely, you know, form those relationships, whether it be institutional or private money lender. So one of the other options is I get a lot of my, I would say first-time home buyers who are credit challenged, not so much maybe credit challenge, I would say maybe income challenge, to where maybe because they're single parent, student loans, or just have a ton of debt, and they want to get out of a rental situation and actually get into a piece of property. The duplex option is what the term I coined for this strategy is basically where you're going to be purchasing a duplex, and you're a first-time home buyer. You want to be in a position to say, okay, I'm tired of renting. Like I said, I'm like living in an apartment or anything of like that nature. A duplex, you usually are sharing a common wall. That's it. And you have your own garage, your own yard, so on and so forth. But it's great to get into it. And the key thing is that if I put clients in this situation to where they're paying equal to or less than what they're paying for rent. And that's usually what most first-time home buyers are looking for. On a single-family resident, in most cases, that's not the case. That's not going to happen, especially with putting down 3 or 3.5%. But putting down 3 to 3.5% with the duplex option, that goal can be attained, because what's happening is you got your tenant on the other side that's going to be paying half your mortgage. So that's usually puts you in a position where you're paying equal to or less than what you're currently paying for rent. And what's nice, whether the property is occupied or not, the way the loan guidelines work is that they will basically credit you 75% of fair market rents, and that's usually determined once the property is appraised. They'll give you credit for 75% of the fair market rent for that unoccupied unit as qualifying income. So you can see where if you have student loans, maybe $400 or $500 a month is basically accounted for, or it's a wash, for example, because now you have some income to offset that along with your earned income to get you qualified for this property. So, and I bring this strategy up in this vein of investment is because this way you can kill 2 birds with 1 stone. This allows you to get into a property, and then after 12 months you can move out and then rent the property, decide out that you were living in. Now, if you have enough equity, you can take some equity from that duplex, go put it down on a single family. Now you have, in essence, 2 rental properties. Well, you have 1 rental property, but you have 2 streams of income coming in from 2 of the separate units that you're renting out. But once again, I mean, 3.5%, and then for some of these programs, we have down payment assistance for this. So for you clients who are, like we say, first-time home buyers with limited income or high debt-to-income ratios, ideal for single parents. That's kind of where I'm usually zeroing on single parents. You know, they're not getting child support or whatever the case may be, but they make good income. But obviously, good income with just with 1 or 2 children is not going to cut it. So they need some kind of release. So that qualifying income gets them within the debt-to-income qualification ranges to get them qualified for the property. Ideal for senior citizens. You'd be surprised how many senior citizens are now actually forced to sell their home because income is maybe cut by 75 or 50%. They cannot maintain, unless that house is going to be paid off once they retire, a lot of them can't maintain that. And from what I'm saying, a good significant portion of the population are retiring with a mortgage, and it's not sustainable. So this is a strategy for those who are in the audience who are real estate professionals, and they have a client who's a senior who's retired and they're struggling. Get them to sell that property, purchase that duplex, live in one side, and rent the other side out. Now they bring their finances back more in line to be able to sustain on a fixed retirement income. So continue here. So we're going to talk, almost going to wrap up here with the duplex option. So as I mentioned, you purchase the duplex owner occupied. So you're going to get the owner occupied interest rate. It's not an investment property because once again, you're going to live in the property for at least the first 12 months. After 12 months, you can move out and rent the other side out. You're only required to live in, as I mentioned, 1 year. 75% of the fair market value is once again applied towards qualifying income. So that makes up for all that monthly debt that you're obligated to pay out. So you have income to offset that. And as I mentioned, 96.5%. And if we go, that's FHA. If we were to go conventional, is 97%. So between 3 to 3.5% down to get you into this property using the duplex option. And like as I mentioned, there's we have a few lenders that do down payment assistance on these. Definitely for FHA, it's kind of, they changed the rules for conventional to where they're requiring a little bit more down, but there's definitely down payment assistance up to 4% on this duplex option. So like I said, we go FHA or conventional, the down payment is covered. So the only thing your client has to just come up with, or you as the individual has to come up with, is the closing costs. So I'm going to open up for questions. Anyone have any questions? So kind of wrap up until questions start coming in. There's no excuse not to get in real estate. So I'm going to say there's a lot of myths out there based on what guidelines used to be, what credit requirements used to be. Interest rates are at historic low levels right now. It's not going to remain that way. I was talking to some colleagues in terms of their scores changes coming as it relates to FICO. It's going to get harder for a lot of people to qualify. Come June of this year, the FICO scoring model is going to change. Those who have FICO scores under 680 that have high debt meaning over 30% utilization of your credit cards, if reference that you use a consolidation loan to pay off credit card debt, you're going to get dinged for that. And of course, student loans. I mean, so basically what's going to happen is this model is going to punish you for high debt and unsecured loans. So I'm getting busy right now with inquiries on refi loans because once this goes into play, you're going to have two things happen. For those who are looking to purchase, who have a FICO score under 680, if it drops below 640 for those who need down payment assistance, they no longer qualify. And as far as refi, if you have scores below 680 and you're trying to pull cash out or get into a lower rate, you may be forced to sell that property in order to get the equity out. So it's important to be proactive in terms of understanding what changes are coming down the pipeline, whether it be for credit, qualifications for loans, you name it, because real estate is a hot commodity. It always have and always will be. We live in a capitalistic society, and I don't care what type of rent control laws that are basically being put out right now, what's never going to happen because real estate is a huge tax generator. No city or municipality or even state is going to go against capitalism when it comes to what revenue real estate generates. And if those who don't know, a lot of investors pull the real estate market out of the gutter when it crashed. So the last thing they're trying to do is really hurt those people as it relates to penalizing them and basically telling them what they can and cannot charge for rent. You as the consumer need to understand that it's no different than owning a car. You wouldn't like if someone put restrictions on you telling you what you can or cannot sell your car for. That is your personal property. And this is where a lot of landlords or investors are going to be protected. And it's unfortunate that you as a consumer maybe cannot afford to pay the rent that the market is demanding. But once again, we're in a capitalistic society, and there's two triggers that basically drive the market: scarcity and demand. And where you maybe cannot afford to pay that rent, obviously there's a huge segment of the market that can't afford, and that's what's driving the rents. And no government's going to get in the way of that. So what I'm trying to emphasize to you as the consumer is you need to basically get in the game, learn the rules, play the game, because this is not new. There's a ton of other groups just basically learning these strategies to combat the problem.
As an investor, mobile homes can be cash cows and an easier, less expensive way to accumulate units as a portfolio investor. what are the rules in terms of finance governing financing or mortgage associated with acquiring mobile homes?
Well, mobile homes, unlike single-family residences, mobile homes are just that, they're mobile, they're not affixed to the land. But there's a huge opportunity. I was actually reading an article about what you're talking about this morning, and this young lady is actually putting on a clinic to teach people on how to basically sell mobile homes, especially in California. Affordability towards housing is just skyrocketing, and this is going to be a segment of the population, no matter what we do, whatever programs we offer, they're just never going to be able to qualify. But I'd much rather see a person basically purchase a mobile home than to be stuck in a rent roll. So for those who are investors looking to invest in mobile homes, there's land loans out there. I would suggest personally, I mean, there's a lot of investors or landowners who own mobile home parks. I would suggest going out and buying those mobile homes, parks, upgrading them, and putting on a huge marketing campaign, because there's some very nice mobile home parks. As nice as, I mean, a lot of them look just like manufactured homes, just the fact that they are not affixed to the land. They're usually propped up or whatever the case may be. And the good thing for the investor is that if they are buying these mobile homes, they can either rent out to mobile homes, or once again, because they own the land, they're charging the rent. You know, there's huge opportunity for that as well, definitely. Any other questions? Well, there's another question. I know I've got some other questions that came in online. So any questions you guys may have, here's my contact information. Feel free to give me a call, email me your scenario, and I'll be happy to answer any questions you may have. We'll be doing some subsequent events like this moving forward, because there's a lot that I'd like to cover, and I'm sure there's a lot Damien wanted to cover. Just not enough to cover in one segment, but this is something that we want to continue doing, because as the rules and regulations change as it relates to investing or getting into real estate, we want to be able to share that information, because at the end of the day, like I say, we have to make sure that we're in the game and not being on the sideline and becoming just a consumer. We need to be a producer, so to speak, in terms of making sure that money stays in our communities, which real quick makes me think about gentrification. If we was to invest in our own communities, when these older homes that our parents or grandparents are living in and they're passing on, stop selling those homes. There's plenty of investors out there that will be willing to come in to help you renovate that property and keep that property as a rental, because this is the reason why we're in a situation as a people in terms of becoming the biggest segment of the population when it comes to renters, because we're quick to sell something because we don't really know the value. Unlike a car, real estate appreciates. My uncle bought his home in San Francisco in 1968 for $65,000. That house is worth $1.5 million. Now you tell me, what asset did you own, past to present, that has accrued that kind of equity or return over time? Nothing. Only real estate does that. So just kind of keep that in mind. Well, thank you for your time, and like I said, we'll be doing this in the future, and if you have any questions, once again, email me or give me a call. Thank you.